My name is Dr. Richard Borghesi. I'm an associate professor of finance and I'm in the College of Business. Okay, so originally I started as a PhD student at the University of Florida. I spent 5 years there. I was an instructor there. When I defended my dissertation, I was offered a position at Texas State University in San Marcos, and I spent about 4 years there. And then a visiting professor position came open here, and I wanted to kind of get closer to the beaches and things like that, and it was a smaller department, which I kind of enjoyed. So I decided to apply for the position, and I've been here since 2008. Well, I didn't know much about the students when I got here, so mostly it was the area and good places to live and things like that. So one of the reasons that drew me here was the lifestyle you could live in Sarasota with all the family things you can do, the beaches and the weather and festivals and art and things like that. Those are the things that drew me to the area. So I've done a lot of corporate finance research. I've done research in prediction markets and in sports betting corruption. I think probably my most interesting area of study is prediction markets. And the reason prediction markets are interesting is because it enables you to say something about the investor behavior in equities markets. One of the problems with directly studying equities markets is you never know what the true value of a security is. You know what the price is, but you don't know if the true value is different than that. And in trying to generate profitable trading strategies, it's very important to know what the actual value is. And one of the things prediction markets enable you to do is to come up with a specific value for a financial asset. And the reason is because the pricing scheme in prediction market assets is a 0 to 100 scheme. And because prices range from 0 to 100, prices directly translate into probabilities. So if you come across a contract that has a price of $40, it ought to expire at 100 at a 40% rate. And what you can do then is you can see exactly how frequently these contracts expire at 100 relative to their price. And you can say something about how accurate people are at assessing values of assets within this market. Just as a for instance, you might have a prediction market contract that says candidate A will win in an election. And if candidate A wins, the price ends up being $100, and if they lose, it ends up being 0. So if you buy an asset for $40, you would expect the probability of expiry at 100 to be 40%. And after the election is over, you can observe what the true value of that asset was, either 0 or 100. This information would be mostly useful to investors in trying to figure out profitable trading strategies. Investors have behavioral biases that affect stock market prices. And if you know about these biases, you can use them to take advantage and try to earn an abnormally large profit by generating a trading strategy based on those behavioral biases. I plan to develop this current research further, but I also have another stream that's I think is pretty interesting. It deals with sports betting corruption. A famous article was published a few years ago that states that about 1% of NCAA basketball games suffer from point shaving scandals. And what a point shaving scandal is when a team is paid in order to underperform so that a bet against that particular team, when it wins, players will be paid from the gambling winnings. And so it's been estimated as many as 1% of all college basketball games are fixed. And the research that I started to do showed that it was actually much lower rate than that. So that pervasive, widespread point shaving theory probably doesn't hold water after some of the research that I've done. People would tend to not want to bet if they believed that such a huge percentage of games were fixed, because what they want is they want a fair competition. They want their dollars to be to have as reasonable of a chance of winning as possible. Otherwise, they won't participate. So sports gambling relies on fairness in betting. Otherwise, no one would want to gamble their money. So really, the whole industry depends on whether or not this type of corruption occurs on this level. All right, so Rick's Research Cafe is a venue where people come together and present their works in progress. That is, everybody here is trying to publish papers in academic or practitioner journals. And these things take a long time to develop. And along the way, it's useful to get feedback from your peers. In the situation we have here, where departments are small and there's several different colleges, what I do is I bring everybody together and they present their research there, and they can get cross-disciplinary feedback on their work and probably gain insights they wouldn't have had they just presented to their immediate peers inside their own college. It also facilitates bringing people together that have complementary skill sets. One person might be great in gathering data, another might have very specialized statistical packages that they're good at. Bring these two people together, all of a sudden you've got something valuable. Here it's pretty unique because in my old school at Texas State University, we had a large finance department. The finance department alone was bigger than the College of Business here. And so there you didn't get as much of a diversity of opinion. When you invite people to Rick's Research Cafe here, you're going to get people from arts and sciences, and education, criminology, all these different areas, and they'll add a different perspective to what it is you're doing. All right, so specifically being here, I like the fact that my department, the finance department, is relatively small. It's just myself and then two other professors. I feel like this enables me to pursue my own research agenda without necessarily having to be in line with what everybody else is doing, because everybody's doing much different things. So I can sort of feel free to pursue my own research interests. It's also nice because I know pretty much all the finance students. They've all been through my principles classes, for instance, and so I get to know pretty much all the finance students that there are. I teach principles of finance both at the undergraduate and graduate level, and that class is interesting because it teaches people the concept of time value of money. If I have money to invest now, I want to get back a positive rate of return and get more money back later than I invested today. How much more is an interesting topic. It depends on how much risk I'm going to be exposed to. So risk and return are this intricate they have this intricate relationship that's very important to understand. By the end of the course, people have an understanding of how to diversify their portfolio, how to make their own investment decisions on some level. Probably an even more interesting course is my Finance Information Technology class, where people download mountains of financial data on stocks and bonds, and we analyze to look at the relationship in risk and return between stocks and bonds. And in the end, they do a project where they're trying to generate a stock trading strategy that beats the market. And so they put a bunch of effort into downloading stocks, looking at how they co-move with or against each other, and try to figure out under what circumstances certain stocks will perform better than others.